On September 15, 2008, the oldest investment bank in America filed for bankruptcy, and nobody saw it coming until it was far too late. The decision to let Lehman fail wasn't made in panic. It was made by men who believed they understood the arithmetic. Treasury Secretary Henry Paulson, Federal Reserve Chair Ben Bernanke, and the heads of America's largest banks gathered at the New York Fed on Sunday night, September 14th. They had maybe 18 hours to decide whether to save Lehman Brothers or let it collapse. What they didn't know, what nobody in that room fully grasped, was that Lehman wasn't just another failing bank. It was a $619 billion institution with tentacles wrapped around the global financial system. Cutting it loose would be like unplugging a transformer without knowing what else it powers. But to understand why they made that choice, we need to go back further. March 1943. Lehman Brothers was already a century old. The firm had survived the Great Depression barely. It had financed railroads, cotton, and oil. It had weathered wars and panics. By the 1990s, Lehman was a heavyweight. Partners made millions. The firm employed 26,000 people globally. Then came the mortgage boom. And Richard Fuld, Lehman's CEO since 1994, made a calculation under pressure that would eventually destroy it. Fuld was 56 years old in 2003. Aggressive, competitive. He'd built his reputation on taking risks nobody else would touch. That year, subprime mortgages were beginning to flow like money from a broken ATM. Banks could sell these mortgages to investment firms who'd bundle them into securities and sell them again. The originating bank had no skin in the game anymore. If the borrower couldn't pay, someone else held the bag. Lehman saw an opportunity. Between 2003 and 2007, it became one of the largest purchasers of subprime mortgage securities in America. The numbers were staggering. Billions of dollars flowing in every quarter. Here's what Fuld knew at the time: these mortgages were risky. He knew defaults were rising. But here's what he didn't know, what almost nobody knew, was that the entire structure was built on a mathematical assumption that couldn't hold. Housing prices everyone believed would keep going up. They always had. It was as close to law as markets get. On that assumption, Lehman loaded up. It wasn't fraud. It wasn't a secret conspiracy. It was a bet. A massive, leveraged, unhedged bet that the future would look like the past. By 2007, Lehman held roughly $111 billion in mortgages and mortgage-backed securities. The firm's total assets were $619 billion. Do the math. Lehman was leveraged 55 to 1. That means for every dollar of actual capital the firm owned, it had borrowed $55. It was standing on a tower of borrowed money, and that tower was only stable if housing prices kept climbing. Then in 2006, housing prices stopped climbing. By 2007, they started falling, slowly at first, then faster. Subprime borrowers, people who'd taken out mortgages they could only afford if prices kept rising, began to default. Not a few thousands, then hundreds of thousands. The securities Lehman owned became worthless paper, but Lehman couldn't sell them, nobody wanted them, and the bank couldn't admit what had happened. Because admitting it meant admitting they were insolvent. For 18 months, Lehman's executives played a game of financial theater. They hid losses. They moved bad assets into special vehicles. They told investors the firm was solid. But the men who actually ran the financial system, the ones who lent Lehman money every single day, they weren't fooled. By September 2008, Lehman couldn't borrow anymore. Nobody would lend to it. The firm was breathing on life support. September 13, 2008. A Saturday, Paulson and Bernanke tried to organize a rescue. They pushed Bank of America toward buying Lehman, but Bank of America's CEO backed away once he saw the real numbers. The losses were too big, the risk was too high. 6 hours later, that deal was dead. Sunday, September 14th. The New York Fed. Paulson made a decision. The government wouldn't bail out Lehman. The reasoning was political and mathematical. The government had already spent $29 billion saving Bear Stearns 6 months earlier. Congress was furious. Taxpayers were furious. And Paulson believed, he genuinely believed, that allowing one bank to fail would teach the market a lesson. It would restore discipline. It would be painful but brief. What Paulson didn't know, what he couldn't know because the data didn't exist in real time, was that Lehman Brothers was wired into the global financial system at 948 different points. It owed money to banks in London, Tokyo, Frankfurt, and Singapore. It had made promises to hedge funds, pension funds, and insurance companies. It was a node in a network so complex that nobody could map it. Cutting it loose didn't teach a lesson. It created a panic. Monday, September 15, 2008, 1:45 a.m. Lehman Brothers filed for Chapter 11 bankruptcy. The filing listed $619 billion in assets and $613 billion in liabilities. It was the largest bankruptcy in American history. By 9:30 a.m., when the stock market opened, the world had changed. The panic was immediate and global. Money market funds, supposedly the safest place to park cash, froze. Banks stopped lending to each other. Credit, which is the oil that makes capitalism run, dried up in hours. Companies couldn't make payroll. Businesses couldn't finance operations. By October, the stock market had lost nearly half its value. Unemployment spiked. Home foreclosures accelerated. The Great Recession had begun. In the months that followed, the government did exactly what Paulson said it wouldn't. It spent $700 billion bailing out banks. It spent trillions more. It nationalized insurance giant AIG. It guaranteed money market funds. It did everything the Lehman collapse proved was necessary. The lesson Paulson wanted to teach, that the market punishes recklessness, was overridden by a harder lesson, that some institutions are too interconnected to fail. Richard Fuld's decision to bet $111 billion on housing prices rising forever wasn't uniquely stupid. It was the decision every major bank made. Bear Stearns made it, Merrill Lynch made it, Citigroup made it, JP Morgan made it. The entire industry was leveraged to a housing boom that couldn't sustain itself, but Lehman made it bigger and with less cushion. When the bet went bad, Lehman went first. The cost was staggering. Global GDP contracted by 1% in 2009. 8 million Americans lost jobs. Household wealth evaporated. Nearly $13 trillion in net worth disappeared in 18 months. Lehman's bankruptcy alone triggered $400 billion in losses across the global financial system. A 158-year-old institution, built by Lehman family members in 1850, ceased to exist in bankruptcy court. The deeper question is whether it had to happen this way. Could Paulson have made a different choice, possibly, probably even, but he made his choice with incomplete information under time pressure, believing he understood the system better than he did. He was wrong, not maliciously, just wrong, and his wrongness cost millions of people their homes, their jobs, and their savings. The Lehman collapse wasn't an accident. It was the inevitable result of decisions made by rational people who didn't have enough information. Richard Fuld bet the firm on a future that didn't arrive. Paulson bet the system on a theory that failed. Both were playing high-stakes poker with incomplete cards. One lost his career. The other lost his presidency's economic legacy. Everyone else paid the bill. Subscribe for the next corporate catastrophe, where ambition meets arithmetic and the numbers don't lie.